Let's go.
Excuse me, Mr. Wealth. I'm taking your class about, how to learn how to get invested into the stock market, how to find stocks and all that. I found the annual reports. I remember you telling us about the annual reports and how important the financial statements are, but I need some help, figuring out how to analyze the balance sheet. Think you can help me out? I'm glad you asked that question. Come on into my office and I'll get you situated. So you want to learn how to analyze a balance sheet, which is one of three of the financial statements that you'll come across when you're looking into any company or any annual report. But let's just say you want to analyze a balance sheet just for your own personal use or for any reason, because it's all the same. We're going to use common sense to come to a conclusion here on what will be considered a really good balance sheet and what will be a bad balance sheet. But we're going to use an example for this one. We're going to use Delta Airlines. So we're going to look at Delta Airlines balance sheet, and I'm going to break it down. We're going to go through every line, and I'm going to tell you what each line mean, how to analyze it, how to factor it in, and pretty much how it relates to you as a shareholder. So starting out, before we even look into the balance sheet, every balance sheet, any balance sheet that you'll come across will always have assets and liabilities. It's a balance sheet, right? Most corporations, or every corporation that I've ever come across, has separated their balance sheet in 4 different segments. So they separated with current assets, total assets, and then current debt and liabilities and total debt and liabilities. That's 4 segments. You have current assets, total assets, current liabilities, and then total liabilities, right? Then there's like an extra, which would be shareholder equity, but I don't want to go too far in this episode, so we're just going to stick to the basics. So 4 segments, right? One balance sheet that you might come across if you use SEC.gov, if you look at Delta Airlines, that balance sheet only goes back 2 years. So it'll show the balance sheet for 2019 and 2018 because we're still in 2020. So you're not going to be able to find the annual report for 2020 because we're still in that year, right? So if we look at 2019 and then you can compare it to 2018 on SEC.gov, but if we use another platform, like I personally like to use Fidelity, Fidelity gives you the past 5 years. So for this example, we're going to use Fidelity's balance sheet. And if you don't know what a balance sheet look like, so just, for entertainment purposes, this is what a balance sheet looks like, right? So take that in. I'll give you a second, and then we're going to break it up. So first we're going to look at current assets. So in the current assets, what they mean by current assets is this is assets that can be turned into cash if they need to, either tomorrow or within 12 months. So shorter than 12 months, that's what the current is like 12 months, right? So the first line that you'll see on the current assets will be cash or cash equivalents. It could be investments and things like that they can pretty much turn into cash overnight. So you have cash. And looking at Delta's balance sheets for the cash, they have about $3 billion in cash. Now, you looking at this balance sheet, you might say that that's $3,000, but since these corporations are making billions of dollars, they consolidate the balance sheet into millions. So you'll read on any balance sheet that I've ever read, it will say all the numbers represented are represented in millions. So that $3,094 that you think you see is actually that 4 is 4 million, that 9 is 90 million, 0 is 100 million, and then 3,000 will be 3 billion. So to make it easier, if you see like 1,000, that's actually a billion. So they have $3 billion in cash, right? You still with me? You good? Okay. So $3 billion in cash, and then you'll usually see the line under that will have receivables. So receivables literally means that Delta Airlines, or any corporation, but we'll just say Delta Airlines, has performed a service and not has been paid for that service yet, but expects to be paid for that service within 12 months or this fiscal year that we're in. So they perform the service, they expect to be paid for that service within this year, the year that we're in right now. So receivables, they have about $2,854,000,000 in receivables that they expect to have this year. So that is an asset. That is an actual asset. That's cash that they expect to come in this year. So under that, then we'll have inventories. Under receivables and cash, we have inventories, and that is exactly how it sounds, like inventory. Things that they have, like products that they sell on the aircrafts and things like that. That could be inventory. That could be anything. Now, if you look at SEC.gov and you go through the annual report, then sometimes they are a little bit more descriptive in the information that they give you on the balance sheet. But like I said, we're just kind of like going through like face value balance sheet with Fidelity, and the numbers are exactly the same if you compare it against the actual annual report that's on SEC.gov or the annual report that will be on Delta Airlines Investors Relations page. It's pretty much just a consolidated form. The numbers are all the same, right? So we have cash, receivables, and inventory, right? The final line in current assets would be just other, which is like $1 billion. So cash is like $3 billion, receivables $2.8 billion, inventory is like $1.2 billion, and then other is like $1 billion, which is a rough estimate, right? And so all of that, if you add all these up on this current assets, you'll come out to $8,249,000,000 for current assets. So that's cash they can have on hand. Now you could go chronically down this balance sheet, or you could just do what I do personally. I just skip to the current liabilities because I'm going to compare the current assets to the current liabilities, and I'm going to compare the total assets to the total liabilities. It's just easier that way for me. So we're going to go through it the way I normally analyze the balance sheet. We're going to do current assets, then current liabilities, then total assets versus total liabilities, right? Now looking at current liabilities, they have $3 billion in current debt and liabilities that have to be paid within 12 months. So the same way that current assets is money that can be accessed within 12 months, the current liabilities is debt that has to be paid within the current 12 months, right? So they have $3 billion in current liabilities and debt. They had about $3 billion in cash on hand, so they could pay that debt like that if they wanted to, but it's safer to just keep that cash on hand, and I'll explain why, in a minute. So under that, you have accounts payable. So accounts payable is pretty much the opposite of accounts receivables. So accounts payable is money that Delta owes that will be paid within this year. It's the same thing. A service was performed for Delta Airlines, and Delta Airlines has to pay that back. That is accounts payable, right? So we're already up to like $6 billion, right? So we're cutting it close on current liabilities. We're cutting it very, very close, right? The line under that will be income tax, and if you look at the reported income tax, like that would be due, that line is just pretty much blank. So we're going to just skip over that. It's pretty much zero, pretty much. Under that, we have other current liabilities, which totals $13 billion. Now, that other could be anything, which is why they labeled it as other. But that other is pretty high. So that brings us to a total current liabilities of about $20 billion, right? So $20 billion for current liabilities versus $8 billion for current assets. Now, I'm going to pause here, and I want you to think about something. Does that sound like a financially stable company? I just want your opinion. So, having more debt than assets is a bad thing, right? Correct? So yes, to answer your question, you are correct. Having more debts than assets is a terrible thing. It's terrible. You wouldn't do that in your own life, and if you did, then a lot of creditors probably wouldn't loan you any more money. So you would definitely want to have more assets than liabilities, but that's not the end all be all when it comes to corporations, because we haven't went through the total assets versus the total liabilities, which is where it really counts. I mean, they can get through a year, they can borrow more money. So now we're gonna just move on to the total assets. Now, the way they break down the total assets is anything that can be turned into like cash a year and out. And that out is indefinite. Like at any time, this is something that can be turned into cash. So you want to think about it like that. So when you're looking at a balance sheet and you see total assets, this is something that they might have for 10, 20, 30 years. And at any point, it can be turned into cash. That's why it would be considered an asset. So it's a long-term asset. So starting off with the long-term assets, we're going to start off with the first line, which would be property, plants, and equipment. So this is any property they own, any plants they own, any equipment that they own that they could sell and get back a nice little return on it, right? So they have $36 billion, $36.9 billion in property, plant, and equipment. It's a lot of aircrafts. Anyway, yeah, so they could sell all of their property, plant, and equipment and get about $36.9 billion in cash if they need to, right? Now, under that line, you will see intangible assets, right? And if you don't know what intangible assets are, then I suggest you Google them. But if you don't have time to Google them, I'll kind of like paraphrase. It is an asset that is not tangible, meaning you can't lay hands on it. It's not a stock also, because you could actually put your hands on a stock. You could actually submit to receive a physical stock, like a sheet of paper. It's not a stock. It is intangible asset. It could be patents or intellectual property, things of that nature, right? So intangible assets, and Delta has $14 billion of intangible assets. Now I want you to remember what intangible assets are, because I will make a point about that later on in this video. So just keep that in mind. Intangible assets, remember that, 14 billion. So we have 36 and then 14 billion in intangible assets. And then the non-current other assets is $3 billion. So when we take all of the current assets, and then we take all of the non-current assets, which is like everything within a year and then everything past that year, we have a total of $64.5 billion in total assets. If they were to completely liquidate the company, they can access about $64.5 billion. Yes, that is a lot of money, right? But we're not finished, because we haven't looked at the non-current liabilities and debt. So we don't know what that number is. That number could be twice as much as that, or it could be half. So let's look into it. So when we look at the long-term debt and liabilities, the first line you'll see is long-term debt. Delta has about $14 billion in long-term debt. So that's debt that they have to pay off throughout the life of the company. So there is no timeline on long-term debt. It could be 1 year and out, but like I said, that debt could be paid in 10 years, 20 years, depending on how they structure their debt, if it's a bond or things like that, of that nature. So long-term debt, $14 billion, that is not bad, right? Because they have about $14 billion in intangible assets. So if they needed to, they could just pay that off from the intangible assets, right? Think about that. But the line under long-term debt and liabilities is deferred taxes and investments, and that's about like $1.4 billion. So we're looking at $1.4 billion. And then when you have long-term or non-current, we'll say non-current debt and liabilities other, we're looking at about $28 billion. So it gets a little crazy. But when we add up all of that, meaning like the current debt and liabilities, which is due within this year, and then the long-term, or they say non-current debt and liabilities, we're looking at about $49.1 billion. So we have $64.5 billion in assets total, and about $49 billion in total liabilities, right? So I'm gonna make one more point about this. So when you look under that, the next line you'll see on every balance sheet is called shareholders' equity. So you as a shareholder own a piece of that company. You own a share of that company. So every asset that company has is a part, you own a part of that asset, right? or every liability that company has to pay out that has to come from those assets or from the revenue, that is money that is yours. So everything that has to do with that company, it is yours. So shareholder equity is what they do is they take up all of the assets and they subtract all of the liabilities, and what's ever left over would be considered shareholder equity, meaning if this company was to shut down and just liquidate everything, that would be the amount of money that would be paid out to the shareholders. So if I had enough shares in this company and this company pretty much fell on hard times and had to liquidate based on the balance sheet that they have now, I would still receive cash, from this company. That's what shareholder equity is, correct? When you look at the line for Delta Airlines shareholder equity, you're looking at about $15.3 billion in shareholder equity. Now, I want to hit the pause button, right? So when we looked at non-current assets, remember I mentioned intangible assets like once or twice maybe, right? Just once or twice. When you look at the intangible assets, you'll find out that intangible assets cannot be turned into cash, cannot be liquidated, because most intangible assets is like goodwill or intellectual property and things like that. Sometimes it's the brand logo, things like that. So yes, if you look it up, intangible assets cannot be liquidated. So when you take that $15.3 billion in shareholder equity, you have to subtract the $14 billion in intangible assets because that wouldn't count as cash. Now, it would count as cash if the company was bought out by another company, because that intangible assets, as crazy as it sounds, would have to be included in the price tag because it shows up on the balance sheet. But we're just saying if this company went under and just stopped and had to pay you out, you would not count the intangible assets as the actual value of the company. Now, being left with about $1 billion in cash is still pretty good. I would say, in my personal opinion, this company is a financially stable company, because when you look at the long term, they have enough cash to get through this year. And so once they have enough cash to get through this year, when you look out past this current year, and this company is still operating even in today's condition, they will still continue to make revenue, but they had cash on hand for bumpy roads like this, and they have pretty much a solid enough balance sheet or portfolio to pretty much go to the bank and receive more money in the form of a loan with low interest rates. So this is just one example of a balance sheet. Tell me if this video was informative. Tell me if you like it. Tell me if you didn't like it. But in the next video, we're going to cover the income statement, because that's the second financial statement that you need to know. So one last question. Did I answer your question? Well, it's time to go make some money now. Or did I help you out? Let me know. Till the next time, hit the like button, hit the share button so other people can learn with you, and hit the subscribe button if you haven't subscribed to my channel, because why haven't you subscribed to my channel yet? To the next one. Let's get it. Let's do it.